If you have a checking account and you are over 60, there are 3 Canada-specific account rules you need to understand in July 2026, and the problem is that most retirees are still using an older mental checklist that no longer covers the real risk. The old way of thinking was simple. Keep deposits modest, use the same bank you've always used, let your pension and benefits land where they land, and if anything important changes, somebody will send a letter. That is exactly where people get caught now. In 2026, the danger is not just what goes over a line. It is what gets tracked, what gets matched, what has to be updated digitally, and what creates a pattern that looks harmless to you but looks unusual to a bank, a platform, or the CRA's systems. I'm covering all 3 today. The old $10,000 belief that leaves seniors too relaxed, the direct deposit and account access change that can quietly interrupt money coming in, and the digital payment trail that can turn ordinary deposits into tax questions if you don't separate personal money from income. Stay with me, because the last one is where a lot of older Canadians are exposed without realizing it. If this kind of breakdown helps you protect what you've built, make retirement simpler, and avoid expensive surprises, subscribe now, because most of the trouble older Canadians run into is not dramatic. It is procedural. It is a missed update, a mixed-up deposit trail, an account lockout, or a habit that made perfect sense 10 years ago and creates paperwork today. And the reason this matters so much for retirees is simple. When you are working full-time, one mistake can be annoying. When you are retired, the same mistake can interfere with benefit timing, direct deposits, tax filing, or access to money you rely on for groceries, prescriptions, housing, and the rest of monthly life. The first change is the one most people still misunderstand. A lot of Canadians still believe the important number is $10,000, as if staying under that amount keeps a transaction out of sight. That is not how the system works. In Canada, reporting entities file a large cash transaction report when they receive $10,000 or more in cash, whether it happens in one transaction or in multiple transactions within a 24-hour period. The same 24-hour aggregation rule applies to certain electronic funds transfers and other reportable transactions. So the old idea that only one big transaction matters is already incomplete. But the bigger issue for seniors is this: suspicious transaction reporting in Canada has no dollar threshold at all. None. That means a bank or credit union does not need a 5-figure amount to decide that activity looks unusual enough to report. It can be the pattern, the explanation, the mismatch between what normally happens in the account and what suddenly starts happening now. If you deposit cash several times in a short period after selling household items, if you keep moving money around in pieces because you think smaller looks safer, or if your account history suddenly changes after years of quiet use, the concern is not just the amount. It is the behavior around the amount. That matters for retirees because retirement banking patterns are often more noticeable, not less. Think about what changes after age 60 or 65. Your paycheck may stop and government benefits start. You may receive CPP, OAS, a workplace pension, and occasional family support. You may sell a second vehicle, clear out a basement, help a child with a temporary loan, or deposit cash from an estate-related situation after a spouse dies. None of that automatically means there is anything wrong. But if the account has been quiet for years and then starts showing repeated cash activity, multiple same-day transfers, or deposits that do not match the usual profile, the old $10,000 myth does not protect you. And if you bank at a credit union because it feels more local and personal, that does not create an exemption. Credit unions and banks still have anti-money laundering obligations. So the safer move in 2026 is not trying to outsmart a threshold. It is avoiding patterns that look like you are trying to outsmart one. If you have a legitimate reason for unusual activity, document it while it is fresh. Keep a note with the date, source, amount, and reason. If you are moving your own money between your own accounts, one clear transfer with a clean description is usually better than a string of smaller unexplained ones. The second change is the one that can hit seniors even if they never deal in cash at all. It has to do with how your CRA-linked banking information gets changed, and how you now have to access your CRA account in order to manage that safely. A lot of retirees still assume direct deposit changes can be handled the old-fashioned way, by phone, through a tax preparer, or by letting someone else update it during filing season. That is no longer the system you are dealing with. Direct deposit registrations or changes submitted through e-file or by phone stopped being accepted in March 2025. In practical terms, if you want to start, stop, or update direct deposit for CRA payments, the secure routes are your CRA account, your bank or credit union, or a paper enrollment form by mail. Then, beginning in February 2026, CRA account users were required to have a backup multi-factor authentication option on file. That may sound technical, but for retirees it is a very real bank account issue, because if you cannot get into your CRA account when you need to, you may not be able to fix banking information quickly, confirm notices, or manage refund and benefit problems without delays. This is where a lot of seniors get squeezed without warning. Maybe you changed your phone. Maybe you lost access to the device that used to receive your code. Maybe your spouse used to handle the login and now you are doing it alone. Maybe you have an old CRA account but have not signed in for a long time because everything seemed to be working. In July 2026, that is not a safe assumption anymore. The CRA has pushed more account management into secure digital channels, including the requirement for backup MFA, and it has also moved further away from older phone-based habits. If your direct deposit needs to be changed because you switched banks, opened a new checking account, or are trying to separate joint finances after a death or divorce, you do not want to discover in the middle of the month that you cannot access the account needed to make the change. And there is another quiet detail older Canadians overlook. If you update banking information, do not rush to close the old account until the first payment actually lands in the new one. That one mistake has created avoidable stress for countless people living on fixed schedules and fixed income. There is another layer to this second change that seniors should pay attention to. Starting in 2026, digital notices inside CRA accounts became even more important, and certain documents are no longer something you should assume will arrive or be retrievable the old way on demand. If you are used to relying on paper habits, this is the year to tighten everything up. Make sure your phone number is current. Make sure your mailing address is current. Make sure your backup MFA is set. Make sure you know whether your direct deposit information is correct. If a spouse handled those details and that spouse is no longer able to do it, treat this as a retirement task that belongs on the calendar, not something to get to later. Because later is when benefits are due, refunds are expected, and call volumes are high. The third change is the one most retirees don't notice until tax time, and it lives inside the ordinary deposits that show up in a checking account from digital activity. More and more older Canadians are supplementing retirement with casual income. Maybe it is handmade crafts, tutoring, consulting, bookkeeping, short-term rentals, online reselling, rides for a local service, or a few freelance projects a year. Some do it for extra money. Some do it to stay active. Some do it because inflation made retirement math harder than expected. Here is the rule shift that matters. Canada's digital platform reporting rules came into force on 1 January 2024, and platform operators that fall under those rules have to collect and report seller information to the CRA annually. That means in 2026, this is no longer theoretical. The reporting system is already alive. Seller information, payment totals, and related details can be reported by platforms that connect sellers to customers for relevant activities. The first reports were due in 2025, and reporting continues annually after that. Now, an important distinction here, because this is where confusion explodes. A pure payment processor is not the same thing as a reportable platform under those rules. So if software only processes a payment, that alone does not make it the reporting platform. But do not let that relax you too much. The tax issue is not solved just because the payment itself came through e-transfer or another simple method. If the money going into your checking account is business income, gig income, rental income, or income from selling goods or services in a taxable way, it is still your responsibility to report it properly. The method of payment does not change the nature of the income. And for retirees, the real risk is mixing several kinds of money together and then forgetting what was what. One deposit is reimbursement from a daughter. Another is a genuine gift from a son. Another is income from selling baked goods every weekend. Another is consulting income from a former employer. Another is rent from a basement suite. If all of it hits the same account with vague descriptions and no notes, you are the one who has to untangle it later. That is exactly why this third rule catches so many seniors off guard. The deposits feel small. They feel casual. They feel personal. And sometimes they are personal. But in the eyes of the tax system, repeated income-generating activity is still income-generating activity, even when it happens on a small scale and even when retirement is your main status. So if you are making money through online marketplaces, services, rentals, or digital platforms, do not assume CRA will treat it as invisible just because it is side money. And do not assume the answer is to stop using digital payments and go back to cash. That can create a different kind of trail if the account pattern changes in a way that looks inconsistent. The right answer is clean records. You need to know which deposits were income, which were reimbursements, which were gifts, which were transfers between your own accounts, and which were simply proceeds from selling personal items. The more mixed your account becomes, the more valuable that record keeping gets. Let me give you a simple example. Imagine a retired teacher in Ontario who sells vintage dishware online a few times a month, helps grandchildren with errands and gets paid back by e-transfer, and also does a bit of paid tutoring during exam season. Nothing about that person feels like a business owner in the traditional sense. But by July 2026, the account can still tell a very different story if nobody labels anything, saves anything, or separates anything. 12 deposits from tutoring. 15 payments tied to marketplace sales. Random family reimbursements. A few transfers from a spouse's account. A tax return that reports little or none of the side income because it didn't seem like much. That is how a harmless-looking checking account turns into an explanation exercise months later. Not because the amounts were huge, but because the story on paper was messy. So here is what I want you to do now, and do it in this order. First, look back over the last 90 days in your main checking account and circle anything that would not make immediate sense to a stranger reading the statement. Repeated cash deposits, repeated same-size transfers, unexplained incoming e-transfers, or several moves between your own accounts in a short period all belong on that list. Second, sign into your CRA account this week, not next month, and make sure you can still access it without problems. If you are missing a backup MFA option, add one. If your phone number changed, fix it. If your mailing address changed, fix it. If direct deposit is wrong, update it through the CRA account, through your bank or credit union, or by mail, but do not wait until a payment is already due. Third, if you changed bank accounts recently, keep the old account open until the first CRA payment successfully lands in the new one. That one step can spare you a lot of anxiety. Fourth, if you earn any side income at all, create a basic paper or digital log with 4 columns: date, amount, source, and what it actually was. Income, reimbursement, gift, sale of a personal item, transfer between your own accounts. Keep it simple, but keep it current. Fifth, if you receive money for goods or services, do not rely on memory to reconstruct it at tax time. Save screenshots, invoices, or confirmation emails now while the details still exist. Sixth, if you are helping aging parents, managing a late spouse's affairs, or sharing money with adult children, be extra careful with cash and transfers that pass through your account on behalf of someone else. The cleaner the paper trail, the easier it is to explain later. And seventh, if you have been using the same account the same way for years but life recently changed because of retirement, widowhood, downsizing, or a move, assume your account pattern has changed more than you realize. What looks normal to you may look new to the system. The biggest mistake seniors make with checking accounts in 2026 is thinking the risk comes only from doing something wrong. That is not how most trouble starts. Most trouble starts with doing something ordinary in an outdated way. Splitting transactions because you think smaller is safer. Waiting to update banking information because the old method used to work. Using one account for pensions, family help, side income, and casual sales with no notes because you know in your own mind what each deposit was. The system does not read your mind. It reads patterns, access credentials, transaction histories, and tax records. And once the paperwork is messy, you are the one who has to make it clean again. So remember the 3 rules. The old $10,000 belief is not enough, because in Canada the 24-hour rule can aggregate transactions and suspicious reporting has no dollar threshold. Direct deposit and account access have changed, because phone and e-file updates are gone for CRA direct deposit and backup MFA became part of normal CRA account access in 2026. And digital payment activity matters more than most retirees think, because platform reporting is already in place and income is still income even when it lands in a checking account in small, ordinary-looking amounts. None of that means you should panic. It means you should get organized before a routine banking habit becomes a problem you have to explain after the fact. If you do those few things now, you put yourself back in control. You make your account history easier to understand, your benefit deposits harder to disrupt, and your tax records much easier to defend. And for Canadian seniors and retirees, that is the real goal in 2026. Not playing guessing games with the rules, not hoping the old habits still work, but making sure the money you depend on keeps moving cleanly, securely, and with as few surprises as possible.